So this is part number 29 of this multi-part video series for positional stock traders. This is an extremely important video. I think that after watching this video, you will thank me. Okay. Anyways, let's see. Why do I say that? It's because in this video, I will teach you how to determine which base is more risky, which base is less risky. In this video, I will also help you understand how to cut your losses short. In this video, I will also help you understand how do you compare the general market index movement with the movement of the stock to determine the risk in the base. If you understand risk, you become a positional professional stock market trader. Okay. So as you can see here, this is an old chart. As per the regulations in India, I am using old charts to illustrate or transfer this knowledge to you. So this is Data Patterns Company. Please pay attention to what I am teaching in this video is extremely important. You will thank me 10 times after watching this video. Okay, because this is very important knowledge I am sharing with you today. This is Data Patterns weekly chart, old chart. Okay, I think more than 2 years old. So have a look at this base. The stock is going up. It has started forming a base. The first thing to understand here is this is not a cup with handle, nor is it a cup. Okay, nor is it a double bottom, nor is it a high tide flag, nor is it a ascending base. So when it doesn't fit any of the given patterns in the book How to Make Money in Stocks by William O'Neill, what they simply do is they write pattern is equal to consolidation. So they just mention that this is a consolidation pattern. It does not belong to one of the patterns mentioned in the book. That itself is the first clue that this base is risky. Okay. The moment they say pattern consolidation, you have to assume that there is risk, more risk relatively in this base. Okay. That's point number one. Point number two, if you read William O'Neill's book, How to Make Money in Stocks, chapter number 11, fourth edition, page number 261, in that book, he writes, on that page, he writes that most winners don't close more than 8% below the, or most winners don't go more than 8% below the correct pivot buy point. And then another statement he makes is that in fact, most of the winners don't close below the pivot point. Okay, so let me explain these two statements. I will repeat the two statements for you. Very important. Number one, most winners don't go more than 8% below the correct pivot buy point. And number two, most winners don't close below the pivot point. Okay. Let me explain this. So here the high of the base is this 1465. So let's draw the levels first. I do this in every video so that you get used to it. Okay. So 1465. Let us give it a blue color. So this is 1465. This will be 5% above that. So I will take my calculator. 1465 multiplied by 1.05. That is 1538. Okay. So that's the buying range. Then we will draw the selling range also. So this will be 1465 multiplied by 1.20. That's 1758. And this will be 1465 multiplied by 1.25. That will be 1831. And we'll give it green color as usual. Okay. So that's the selling zone, that's the buying zone, and we'll draw the stop loss zone as well. will be red color. This number is 1465 multiplied by 0.92. That's 8% stop loss, 1347. And this number is 1465 multiplied by 0.95, 1391. Okay, very simple. Okay, so we have the base, we have the buying zone, stop loss zone, and the selling zone established. Okay, what was the first statement? Winners don't go more than 8% below the correct pivot buy point. So the correct pivot buy point is the high of this bar, which is 1465 in this case. Okay, so let's move it one step forward. And by the way, the latest week closing price before the stock broke out was below the 10-week simple moving average. That adds to the risk. Now I will move it forward. It starts to move up. See, it goes in that week. In that week, it goes in the blue zone. Okay, and that to an extraordinary high volume, more than 4 times the average weekly volume. So that can be considered as a breakout, because breakout doesn't mean that it has to go beyond the blue zone. Even if it breaks the pivot, touches the pivot, tries to go in the blue zone, that on high volume, that's a breakout. Okay, so I would call that candle as a breakout candle or a breakout bar. Okay, but you see, just before that, there was no pattern. It was neither cup with handle, nor was it a cup, nor was it saucer with handle or saucer without handle, or flat base, or ascending base, or high tide flag, or double bottom, or any of the bases that was mentioned in William O'Neill's book. This is pure consolidation pattern, okay, which is a risky pattern. So the first level of risk comes from the fact that it is not a proper base, it is consolidation. Number two level risk comes from the fact that the weekly closing was below the 10-week simple moving average. Okay, very, very simple. Now, the stock tries to break out. Okay, remember that statement, real winners don't close more than 8%, don't go more than 8% below the pivot buy point. And the second statement was, in fact, the real winners don't close below the pivot point. Now, when he says close, he is not mentioning weekly close or daily close. So let me explain what he's trying to say by that. So I will uh, move this week forward. Okay, that's the week, that's Friday. Okay, now that ignore this. Okay, just focus on this bar. What did William O'Neill say? Real winners don't close below the pivot point. So what's the pivot here? 1465. What is the close of this candle? It is 1422. What's the pivot point? It's 1465. Okay, so which means in this week the stock has closed below the pivot point, which means what? Real winners don't close below the pivot point. This stock has closed below the pivot point, which means what? You have to lighten up on your position. You don't have to wait. See, at the end of the week, you don't have to wait till the stock falls 5% or 8% or hits your stop loss. Before even this week starts, okay, on Friday, just before the market is closing, like 5 minutes or 10 minutes before the market is closing, you know that the stock is going to close below the pivot point. You have to start reducing your position size. Okay, that is how you manage the trade. You don't have to wait till the stock hits your 8% stop loss. The goal is to cut your losses short and let your profits run. Letting your profits run is very easy because you have to follow the 10-week simple moving average. As long as the stock remains above that 10-week simple moving average, you are doing fine. But when it comes to cutting your losses short, you need some clues, right? I'm giving you that clue here. If after you buy, let's say out of 100 shares, you buy, let's say 50 shares. First of all, you wouldn't buy this base because it's too risky. The closing is below the blue line. But I'm just explaining to you, if at all you end up buying this base thinking that the stock has broken above its all-time high and it will continue to go up because this was an IPO here, it will continue to go up. You need to look out for some clues to cut your loss short. And this is the first clue: close below the pivot point. Okay, most winners do not close below the correct pivot buy point. The fact that it has closed, that too on high volume, please pay attention to the volume. Okay, that is the signal to at least lighten up on your position, cut your position size, or maybe sell everything. Okay, selling everything would be the right thing to do in most cases because this is not likely to be a big winner. Okay, because there are too many risk factors here. The week before the breakout, the stock was below the moving average. Then this is not a proper pattern, it is simply a consolidation pattern. And then third, the stock has now closed below the pivot point. When too many risk factors begin to pile up, plus high volume close, high volume red bar, when too many risk factors begin to pile up, you have to start cutting your position. This is how you keep your losses below 8%, but you can let your profits run and you can book profits at 20-25%. Imagine booking profits at 20-25% when the stock goes in your favor, and booking your losses at less than 8%. Overall, in the long run, on a portfolio level, the reward to risk ratio will favor you. Okay. So you saw the 4 levels of risk here. Level 1 risk is it is not a proper pattern. Level 2 risk is the close was below the 10-week simple moving average. Level 3 risk is the stock closed below the pivot point. Level 4 risk is high volume weakness. Correct? So these are the 4 levels of risk. This is how you determine whether the base is less risky or more risky. Okay, we will discuss this further. Another level of risk I will teach you. Okay, see, this is the week of wait, let me, yeah. So this is how the stock falls from the top, right? How much is the fall? Now pay attention to this discussion carefully. How much is the fall? It's roughly 31, 32%. Okay. Now, whenever a stock falls, generally it is because of the general market weakness, general market index is falling. So this was 19 December 2022 week. Let's go to Nifty chart, 19 December 2022 week, and see how much Nifty had fallen from the top. Okay. Now you will have to remember one rule I had taught you in this video series. I don't remember the exact part number, but I had taught you that if the Nifty falls 10%, then your stock should fall 10 to 25%. The stock should fall 1 to 2.5 times the fall in the Nifty for it to be a normal price action. Okay. If it falls more than 25, that stock is very risky. That base is faulty. It is risky. So let's go to 19 December 2022. Wait. Yeah, this is Nifty. See, this is 19 December 2022. So let's see from the top how much it has fallen. So from here, Nifty had fallen 5.88. So let's 6%. Okay. So which means during this period from the top till bottom, the Nifty had fallen 6%. So stocks, the leading stock should fall 1 to 2.5 times 6%. What is 1 time of 6%? That is 6%. What is 2.5 times of 6%? It is 6% plus 6% plus another 3%. So 15%. So if the Nifty falls 6%, then your leading stock should fall 6 to 15%, not more than that. And how much is data pattern fall in that period? It fell 33%. That means it fell twice of more than twice of 15%, which means what? Another level of risk. This stock is not a leading stock. By the way, the relative strength of the stock at that time was 88. So although on a relative strength rating basis, the stock looks like a leader, but when you compare the movement of the price of the stock with the movement of the price of the Nifty, you know that there is risk in that base. Okay, so that's another level of risk. This stock from the top should not have fallen more than 15%. if we compare its performance with the Nifty, but it has fallen 33%. That adds to the risk, another level of risk. So I want you to check whenever I want you to check the distance between the top of the base and the bottom of the base. And during that corresponding period, I want you to check the Nifty's fall in the same period. Okay, it should be between 1 to 2.5 times the fall in the Nifty. Okay, you understood how I am looking at risk. I am comparing the performance of the stock with the performance of the Nifty. I am looking at the depth of the base. I am also looking at the name of the pattern. I am also looking at price and volume. Okay, I am also looking at the moving average. See, everything is there on the chart. You don't have to do anything else. You don't have to go anywhere. Whatever factors I am telling you, please note down these factors. I am also looking at the pivot. Remember the two statements? Most winners don't correct more than 8% below the correct pivot buy point. Number two, most winners don't close below the correct pivot buy point. Okay. How to Make Money in Stocks, written by William O'Neill, chapter 11, page number 261, fourth edition book. Mark these two statements. You will find these two statements in that on that page. Highlight it with a highlighter. Okay, that's a clue given to you by William O'Neill based on his decades of experience that you can use to manage the trade. You can use that rule to cut your losses short. You can use that rule to let the profits run. You can use that rule to determine whether you are involved with a winning stock or you are not involved with a winning stock. Even the market rule that I told you, it comes from the book How to Make Money in Stocks. I don't remember the exact page number, but the stock should not fall more than 1 to 2.5 times that of the market downfall. Even that comes from William O'Neill's book. This is nothing new that I'm teaching you. Everything is there in the book, but people don't read the book properly. That is why I'm explaining these things to you uh, in a very granular way so that you can understand that the situation that you're involved in, is it a risky situation or is it a less risky situation? Okay, let's continue the discussion forward. Now I will remove these levels. I will move the stock forward, okay? Because the stock formed another base. See, this went up above that level. Even this bar went up above that level. Now, after this candle, you have three consecutive bars, which are below the high of this. Now, that means the high of this bar becomes the new pivot point, right? So let's say this was base number one. This is base number two. This is base number two again because the stock did not break out properly. It came down and hit the stop loss. Yeah, see, the red was taken out. Okay, so it hit the stop loss. And that was expected, right? The base was risky, the base was faulty, the base was deep and loose, and the stock fell more than 15%, which means the probability that if you buy the stock here, the probability of losing money was more than the probability of making money, and that is exactly what happened. Okay, but now you see it starts to form another base. Now we see, let's say the high of this candle is 1540. Let's draw the pivot. So this is 1540. This is more than 5%. 1540 multiplied by 1.05. 1617. 1617. I'll give it green color. Sorry, what happened here? Oh, can you see this now? I hope. What is happening? Well, let me see what's happening here. I don't know whether you can see this or not. I hope you can see the chart. But anyways, just a second. Yeah, I think you can see it. Let me go to my, something happened here. I'm not able to see myself. But anyways, let me draw this. I will continue this. Okay. So this is the pivot point, pivot range. Then let's draw the green zone. I don't know why am I not able to see myself. Let me see the view. Anyways, forget about it. Let's draw the selling zone. So this is green. This is 1540 multiplied by 1.20, 1848. Then this is 1540 multiplied by 1.25. That is 1925. Okay, that's the selling zone. And then the stop loss zone, let's draw that. This is 1540 multiplied by 0.92, 1416, 1416. And this would be 1540 multiplied by 0.95, 1463, 1463. That is a red color. Okay. So now you see this base. So this is base 1, this is base 2A, this is base 2B. I will move the price forward. When the breakout happens, you see the breakout has happened. After this, you have to see whether the stock closes below the pivot point in a particular week, or I would say even in a particular day. If you want to take less risk, you have to look at the close on a daily basis. If it closes below the pivot point, you have to start lightening up on the position. But if it closes below the pivot point at the weekly close, okay, then it is too risky, right? Now you see, I will move it forward. See what happens here. It reaches the selling zone. Okay. Now during that price rise, you see 1, 2, 3, 4. In these 4 weeks, this is like more than a month. Okay. The stock held up above that pivot point. It never even touched the pivot point. Okay. Here there came a time when it momentarily went below the uh, pivot point, but I think the close during the day was above the pivot point. Obviously, during the week it was above the pivot point, so there was nothing to worry here. But as you can see, coming back to the two statements, the winners do not close more than 8% below the correct pivot buy point. Okay, do not go below the 8% below the correct pivot buy point. So that means this stock, after it broke out from here, never came near that 8% below the pivot point. As you can see, it never came near. In fact, it always continued to remain above the 10-week simple moving average. Plus, it never closed below the pivot point, buy point on the weekly chart. Okay. Daily it might have, but on a weekly it never closed. So that's the winner for you. It took some time to get that gain, but that's the winner for you. And you see this downfall, it's not much of a downfall. And this was termed as a flat base by Market Smith. So 22% is fine. But this was termed as a flat base by Market Smith. You can check Market Smith chart here. But you see this base number 2A did not work. Base number 2B worked. Moreover, I will, if you notice these three bars, 1, 2, 3, look at the tight closing prices. Look at the small spreads. Remember last to last video, I spoke to you about uh, constructive basing patterns have tight price areas, correct? That is the concept here. In this base, you don't see that happening. Okay. In this base, you have tight closings. Okay. Flat base, very small base, tight closings and small spreads. Okay, that is why the risk in this base is low compared to the risk in this particular base. In this, the decline was very sharp. In this case, the decline was not very sharp. Most of the bars are in low volume. So it never closed below the pivot point on the weekly time frame chart. It never came near the stop loss range. That's the sign, or that's the mark of a winner, and it did hit the selling range. Okay. Thank you so much.